Hello everyone, welcome back to our corporate action series and this is 10th video and today we will be diving into a concept of takeovers in the investment banking world. I am Viraj Teral, your investment banking operations trainer, and I'm excited to walk you through this critical corporate action that reshapes companies and financial market. Let's start with the basic. A takeover happens when one company acquires control of another by purchasing a majority of its shares. So this often leads to a change in management and operational structure. So there are two primary types of takeovers. One is friendly takeover and second is hostile takeover. So let's talk about friendly takeover. So in the friendly takeover, the acquiring company makes an offer and the board of directors of the target company agrees to the acquisition. So this is often a collaborative process where both the parties negotiate terms and benefit their shareholders. Example, think about Tata Motors acquiring Jaguar Land Rover. So it was an strategic, mutually beneficial move that was agreed upon by both the parties. On the flip side, we have hostile takeovers. So here the target company's management does not want the takeovers, but the acquiring company proceed by directly offering to buy shares from the shareholders, often at a premium. So this can cause internal disruption and management changes. An example of Indian market would be L&T's hostile takeover of Mindtree in 2019. Now let's go through the key steps involved in the takeover. First step is acquiring shares. So the acquiring company either buys shares directly from the shareholders or negotiates with the board. Second is due diligence. A thorough financial and the legal assessment of the target company is conducted. And in the third stage, financing deal. So the acquirer may use cash, stock, or combination of both to finance the acquisition. And in the fourth stage, regulatory approvals. So depending on the country, regulatory bodies like Security Exchange Board of India, SEBI, or SEC in US must approve the deal to ensure fairness and transparency. So there are several strategies used in the takeover. So let me explain three common ones. First is tender offers. The acquirer offers to buy shares directly from the shareholders, so often at a price higher than the market value. So this bypass management and allows acquiring company to take a control quickly. Second is proxy fight. So in this strategy, the acquirer tries to replace the target company's board of director by persuading shareholders to vote for their candidates during the annual meeting, and this is the way to gain the control without buying the share outright. And third is creeping takeover. So this happens when the acquirer slowly buys shares on the open market to eventually gain majority control without causing abrupt change. So these are the strategies used in the takeover. Now let's talk about takeovers can have a significant impact both for the companies involved and for the market. So for the target company, the takeover can bring in the fresh management ideas, improve financial efficiency or operational efficiency, or sometimes even lead to job losses and restructuring. For shareholders, the shareholders of the target company often benefit from the premium paid on their shares. However, there can be also be a risk if the deal does not go through. And third, for employees. So acquiring company may change the target company structure that leading to layoffs or change in the management and operational procedure. So how does this tie into investment banking operation? So in any takeover, investment bank plays a key role. that is advising on the strategy, conducting financial analysis and valuations, arranging financing for the deal, ensuring smooth execution and settlement of the transactions. So investment banking operations professionals are responsible for managing the complex logistic, ensuring that the acquired shares are transferred correctly and the deal companies with the regulatory standard. Now let's recap the key takeaways from this video. A takeover is when one company gains control over other. The friendly and the hostile takeover differ based on the target company's willingness. Then there are several strategies like tender offer, proxy fight, and creeping takeovers used in the execute takeovers. And fourth is investment banking operations plays a critical role in ensuring that the successful execution of this deal. I hope you found this video informative. Make sure to check out our previous videos in the corporate action series if you haven't already. If you are looking to dive deeper into the world of investment banking operations, subscribe to our channel and stay tuned for our next video. Don't forget to like, comment and share this video with your friends and colleagues. See you in the next one. Thanks for watching.